Well, Mark, let's move on now for the latest on what's happening in the equity markets. We're joined by Caron, market strategist at Stifel Nicolaus. So, Kevin, you said that this rally is interesting but not convincing. Are you concerned about the market fundamentals?
I'm not sure that I actually said that. It is interesting to see that the market has moved materially off its lows that we saw in March, and it's more interesting to see that some of the fundamental characteristics of the economy are picking up. When we look at things that are leading economic indicators, for example, when we look at things like the inventory to sales ratio for durable goods, when we look at this, the steepness of the yield curve representing the forward look on credit, when we look at what's happening in terms of initial jobless claims, all of those things suggest that there's some improvement in the economy. But there's a wrinkle in this, because when you look at the coincident economic indicators, things like private sector employment, what private businesses are doing in terms of making investments in their own business, at the grass level, you're not seeing the uptick of all of the good things that we've seen in credit markets and in the stock market the last few months. You're not yet seeing those in terms of businesses putting people to work and making investments, and that's a very important element for the next step of what happens in this recovery process.
Kevin, is government intervention giving you cause for concern?
Well, government intervention always has unintended side effects and consequences.
And not all of them good, correct?
Not all of them good. It depends really on what your school of thought is. If you're a Keynesian at heart, you're going to look at what the government is doing and see it as absolutely necessary for fixing the narrow issues of the problems that are in the economy in the here and now. But if you're of a more free market orientation, you're going to look at these things and see and wonder what kind of threats those actions bring to the longer term scenario. And what I've been hearing when I look around at other people who are commenting on this is I'm hearing a lot of concern about what the long run looks like in terms of long-run growth rates. And almost across the board, what you hear is that the expectation is for a return to growth, but something that's very, very, very different than what we have seen heretofore. And my concern would be that while we may get quickly out of the ditch, it's not going to put us back on the road towards prosperity as we defined it in the last 10 or 20 years. So it's a different world we're moving into.
And Kevin, as for commercial real estate and concern for consumer spending and pressure on the residential and depressed earnings still ahead of us, all these add to your concern for the outlook ahead of us?
Well, as I said before, the supply of credit has gotten better. Some of the leading economic indicators have gotten better. It's nice to see stocks up, performing better relative to bonds. So there is some risk appetite on the part of investors. But now that the fire has been started, we really need to see whether or not the animal spirits of the economy really take off from here and carry the economy the rest of the way. And what we're seeing at this point is still a lot of hesitation on the part of businesses in Main Street America to make those very critical investments. So we're somewhat concerned about that, and we think that we're probably on a short-term basis a little bit overbought here, and we could see a pullback from where we are.
Kevin Caron, market strategist at Stifel Nicolaus & Company, joining us this afternoon. Kevin, thanks.